Hello and happy Friday Eve. Rebecca Steinhouse here with Craig Stelzer for our weekly-ish cross-country conversation. Thanks again, Craig, for coming.
Sure.
So today I wanted to ask you if, let's say, I'm a new home buyer, I've saved my money, and I have a few $1,000s in the bank, I'm ready for a down payment. What do I do when it comes to those closing costs, and how much usually are closing costs? Because I know a lot of people don't always see that in the future. They're just like, oh, I'm ready for a down payment.
Sure.
Now what do I do?
Yeah, that's a great question. So here in South Florida, closing costs, especially in Palm Beach County, can be anywhere from maybe 2.5% to 4% of the purchase price, depending on, some costs aren't proportional. So like on some smaller condos, for example, the percentage of cost may be higher than on like $1 million house. So generally speaking, let's just say it's about 3% of the purchase price for closing. It's very common that people get gifts from family. Yeah. Usually, in this market, especially where it's real competitive, it used to be that you could ask the seller to pay for all of your closing costs. And so a lot of buyers, it's great. In concept, it's
pay for my stuff.
Well, a lot of times what they'll do is, like, if it's a $300,000 purchase, they'll go say $310,000 on the offer and ask for $10,000 back. So net, the seller is getting what they want.
I see. Okay.
The rub in that equation is sometimes the appraisal may not support the sales price, and so that's the first thing to go away. Or if someone is, buying a house that's a hot house, and someone else is applying or making an offer, if you have a seller concession, yours is going to go into second place versus the one that doesn't, right? So assuming you can't get a seller to pay your closing costs, one of the first things that a lot of younger home buyers do is they get a gift, or other buyers, you can get a gift from family. Yeah. Right? And so a lot of times, just starting out, it's hard to accumulate money, and a down payment can be a lot. And so it's okay. You could do, on conventional mortgages, VA mortgages, FHA mortgages, you could be 100% gift funds. So in other words, even if you didn't have a down payment, you can qualify with your income and credit, and someone else, family, can give you all of the money towards it.
But how do you prove that where that money's come from?
Right.
Like, how are they going to even approve you for mortgage payments?
Sure. So, the mortgage payments are based on your debt to income and credit.
Right.
So the way that you can service the debt moving forward is based on how much money you make, your overall debt load, your credit score. That's how you demonstrate that you can pay the mortgage. Okay. How you can get into the house and verify the assets is every dollar that goes into a mortgage transaction needs to be verified, right? So when it's a gift, generally you need a gift letter from the donor. And so we have a template form for each file where we'll provide that to the donor. And then if it's a conventional mortgage, the only thing that's required is the donor's ability to give the money. Okay. What that means is we don't need their bank statement.
So it's not, when it comes to these, like a gift, it's not like my dad hands me a check for thousands of money, I deposit in my account, and then say, look, I have the money.
No suitcases, no envelopes, no wheelbarrows at closing.
So they would have to provide their information and say, this is what's going on.
Correct. So a donor can either give you the money up front. They can do a check. We'll need a copy of the canceled check once it's cleared. Okay. The easiest way is they can do a wire, because if they do a wire to you, all we need is the wire receipt afterwards.
Would they be wiring that to us, or like me as the buyer, or wiring it to like the escrow?
It could either be wired to you directly, or it can be wired directly to the title company. Okay. Either one. If it goes, if it's for the down payment, generally it'll go directly to the title company. If it's for the money at closing, a lot of times you don't know exactly how much money it's going to be, and so a lot of times at the last minute they'll just wire it directly to the closing. So usually we'll get a gift letter filled out for the entire amount that they need, and then they'll just send the money, and the title company or you will either have to prove. We'll get a printout of your bank statement that shows that you received the money, or the title company will give us an escrow letter.
Gotcha.
Now so that's conventional mortgages. Yeah. Now for a government-backed loan, like an FHA loan, a VA loan, the donor actually has to show their bank statement. Oh. Right? So like whenever there's a donor, or whenever there's like a family that's co-signing for a loan, am I off the screen? No, you're right. Sorry, I was drifting. it's always a good idea to have, like, if you're the borrower, you should always have the tough conversations with your donor or your cosigner early on. Like, look, it's not just as simple as you giving the money.
Yeah.
It's not just as simple as you co-signing.
Yeah.
You have to show everything. You got because usually what happens if that doesn't happen, if you don't get ahead of it, it can cause people don't want to give up their private information, especially when they're not. What's in it for them? Like they're not actually getting a house.
Yeah.
So it's always
when it's your mom or dad, I'm sure they're like, okay, yeah, let me help you out. But really?
Not always.
I would be like, oh, okay.
Your mom, maybe.
To do.
Trust me, over time, I've seen everything.
Oh my god.
Yeah. So, it's a good general practice just to tell them exactly what's expected from them. Let them know what they're agreeing to.
I can't just have a check. This is what's going on.
Because if you go to contract based on your dad, let's say, verbally committing to give you $10,000.
Yeah.
And then 2 weeks later, you're like, well, I need your bank statement. He said, well, hell no, I'm not giving you the bank statement. Now you're going to be in trouble because you're in a contract.
Oh, my.
Right? So you always want to get ahead of that stuff. Now, FHA, VA is a little more strict because it's the government background. So they want to see the actual bank statement or the investment account where the money comes from. One of the big and on jumbo loans are different because...
Yeah, those are a whole different beast.
Yeah. It depends on where you're selling the loan to. That said, one of the biggest questions that I get is about using cash. Like, how can you actually document cash on a transaction?
Yeah.
Because a lot of people are in, say, service businesses where they deposit cash or,
the mom and pop shop.
There's a lot of barbers, there's a lot of hairdressers, there's a lot of wait staff, there's, anywhere where there would be tips. Yeah. It's very common here. And so, general rule of thumb on FHA loans is you can have up to 1% of the loan amount in cash deposits in your bank. $200,000 loan amount, $2,000 cash. On conventional mortgages, it can be up to half your monthly gross income. So if you make $5,000 a month, you can have up to $2,500 in cash deposits. No explanation.
Okay.
If it's above that, you just have to document it. So
like
if it's a cash tip, go ahead.
So if you're saying that if I'm a waitress and most of my income is cash and I'm depositing so much money every week, how would I prove that I'm like where that money's come from?
So if you're claiming those tips, then we have the paper trail.
Okay.
So we can show deposits and then we can show the pay stubs.
Okay.
The problem you run into sometimes with wait staff is that they don't claim them, but they still deposit them. Right. So and that's why I think there's some latitude where you can do up to half of your declared income in cash.
Gotcha. That's a big one, though.
Yeah, so it's not so crazy. And you can spread it out sometimes. Like maybe if your income's $5,000, you can do $2,500 this month, and then you can do another $2,500 next month to get it in there. But generally, if you have the paper trail, sometimes people will sell things right before closing. Yeah. So like if I'm talking to someone,
sell my car.
Right. Yeah. It happens all the time. And
there's $3,000 right there.
Yeah. So as long as you have a bill of sale, that works.
Okay.
Let's say you're renting a property out. Let's say you own a house and you're moving to another house without selling, and you need that landlord or the tenant. You need proof of that they're going to be your tenant in order to qualify for a mortgage. Another time, you can't have cash. You need documentation of that money.
Right.
So in that case, just like with anything, if you have the right paper trail, lenders are going to accept it. You sell a car, get the bill of sale. You sell whatever equipment or something, paper trail.
I've heard of stories where
don't accept cash though. Get a cashier's check or a check from the person.
I've heard of stories where it was like mom and pop shops and they couldn't prove that they were making so much money because everything was in cash. So how would you like go around?
I mean, that's two issues in one. That's the asset issue because it's all cash being deposited. Yeah. And then if you're not claiming it, you run into an income issue. So self-employed people have a tough go at getting mortgages these days for that reason because a lot of people don't claim, and it's nothing wrong per se. I mean, they have good accounting or they don't want to just volunteer to pay more taxes. But government isn't going to allow you to qualify for a mortgage on income that you didn't pay taxes on. So that's where you have like bank statement loans and things like that as alternatives.
That's interesting. So always keep track of it. Try to get cashier's checks from your tenants, or if you're selling a car or
keep records. Keep records. Yeah.
Scan and save. Scan and save.
Keep records of things, detailed records of things.
Stay organized.
Gifts are fine. Money from a business is fine for down payment.
Mm-hmm.
So if like you have a business or you're a business owner and you keep your money in that business account and you never really move it over to personal, like you use that and aggregate money, you can take distributions from a business.
Okay.
You can take money out of a business. Something that people use a lot is but loans against retirement accounts. So like, let's say you've got some 401k.
Yeah.
And you don't want to take the money out because, you don't want to take the money out because you don't want to pay tax on it. Or maybe the market's at an all-time high and you don't want to withdraw it.
Yeah.
Most 401ks will allow you to borrow some value of it for home purchase with favorable terms.
Without being like taxed or
without being taxed. It's a loan.
penalized?
It's a loan.
Oh.
And then it gets paid back generally through your payroll. So I have a lot of
that would be a loan for your down payment?
Yes. Or closing costs. Let's just say you're short $5,000, whether it's down payment or closing, and you've got 10 in your 401k.
Yeah.
Sometimes you can borrow that $5,000 from the 401k instead of having to get a gift or instead of having to, accumulate more payrolls and push a closing back. A lot of people do that.
I didn't know that.
You kind of bridge yourself. Yeah,
I
like you
learned
give
lots
yourself a
today.
bit of a loan. And that's one of the things that people do that pretty often.
That's interesting.
And it's favorable because, again, you're not paying tax on the money.
Yeah.
It's less expensive, and sometimes asking a family member for money isn't, if they don't volunteer and you have to ask for it, it can be pretty awkward.
Yeah.
People want to
Unless
do
you're
things on their own.
still living at home with your parents and they're like, get out, and I'll do anything to get you out of here.
Yeah, here's my wallet. So yeah, those are some of the tricks of the trade. Just like with anything, call us if you're not sure. Generally, call before you do something. You don't call.
Yeah.
People shoot themselves in the foot sometimes.
No, you're great. Like, even, I think it's good to start, like, if you even have the idea of buying, like, call Craig and be like, what do I need? What are the steps? What do I need to do?
Yeah.
I know even you and I have talked about it, like, when do I need to start, like, getting my credit going and saving money and doing all of this? I think that maybe our next video we'll talk about saving money and, like, how much you should save and different ways to do that, because I know that that's a lot of people struggle with that down payment. I think that's the biggest thing. Yeah.
Yeah, costs are going up on things, and
the closing costs. No one thinks. If you haven't bought a house before, you don't
think about it.
Think about it.
No, I agree completely. That's nothing to be scared of. I mean, there's, just like with anything, if you plan, it usually works out in your favor.
Right.
Right. And so a lot of people get impulsive and they rush into things, or they wait till they're like 60 days out from their lease expiring.
Yeah.
To start going to look for things.
Yeah.
Now it's like fire drill.
Do like a year.
6 months, 8 months. Yeah. Get ahead of it.
Yeah.
Yeah. With so if people get in touch with us early on, or their lender, anyone early on, they start saving towards something early on, they can accomplish goals. If
you don't plan, you plan to fail.
There you go. You heard it here.
Right here, cross country conversations.
There you go.
So I don't even know what episode this is, but yeah, we'll be back in 2 Thursdays, and we might be talking about savings and how to get ready to buy a house. If you want to know anything, just comment below and follow Craig on Facebook.
Sure.
What is it, Craig Stelzer? And I think Cross Country Mortgage Del Rey. Yes. And then also follow Remax Services. If you have questions, comment below. Otherwise, see you soon.
Thank you.
Thanks.